Hello and a very warm welcome to this Master Investor monthly mashup at the beginning of June with myself, Sarah Lowther, and Jonathan Davis, author, investor, podcaster, editor of the Investment Trust Handbook. Now, Jonathan, last time we were talking, the theme was sell in May and go away. However, I am sensing a difference on the corporate landscape. I've been really busy this week, despite the fact that there's been 3 long bank holiday weekends. More companies are wanting to talk. I'm reporting on more mergers and acquisitions news. I'm hosting more webinars. So I'm feeling that either the chief executives are talking the market up, or it is because the market is on the turn. What do you think?
Well, I think it could be. I hope it is. I'm not convinced that it is, but I think it might be. Which is to say, another roundabout way of saying that as far as I can see, I think the signs are still, there's a lot of uncertainty out there, and investors are still making up their minds. What you have, I think, identified is the fact that corporate activity and M&A activity, private equity activity, is picking up as a direct result of what's happened over the last 18 months or so, which is the sort of bear market and then recovery we've had. So I think there are evidence that there's been some mispricing in the markets, let's put it that way, in the eye of the beholder at least. And so I think we will see some more M&A activity, particularly in the UK, which remains unloved and pretty cheap on most traditional measures. So to that extent, I think this is what we would hope to see if the market was about to turn. I just think that the big macro picture on inflation and interest rates and so on is still not particularly rosy, but there are opportunities clearly from mispricing that's going on at the moment.
So yesterday I hosted the Master Investor Gold webinar, and in fact there was loads of regimental officers online with me. I didn't know that the managing director, the chief executive and chairman of Condor Gold, he was a young officer in the Gurkha regiment in the Himalayas. And our guest speaker, Charlie Morris, was in the Grenadier Guards. He's the founder of BiteTree.com, BiteTree Asset Management. And he was talking about gold, and he said that he feels as though gold's gone as high as it can go this year. And he sort of models gold as if it were as if it behaved like a bond, and he was talking about inflation and interest rates. Though he didn't paint a declining picture for gold, he just doesn't think that we're going to see it go any higher this year.
Yeah, well, funny enough, I've known Charlie Morris for a long time, for about 15 years. I think I've been talking to him. He's a very good man, and he produces some excellent material, I have to say. And he has this, as you say, he's got this, developed this, he used to be a kind of strategic asset allocator for HSBC back in the day, big institutional business. But he left to start probing around in gold, and more recently Bitcoin as well. He's a big advocate of Bitcoin as well. And he's developed this interesting theory that if you combine gold and Bitcoin together, you'll get something which is better than either of them. It gives you a less volatile return. Again, I'm not entirely convinced by that, but Charlie's a charming fellow, and as you say, he's very organized, as military men are, and he's I think it's an interesting idea. Whether he's right on the markets, well, again, another matter. I mean, we're all kind of probing away here, trying to get a handle on what is an extraordinarily volatile period, lots of uncertainties. I've been talking to a well-known kind of strategist called Russell Napier, who's at the kind of gloomier end of the perspective, I think it's fair to say, this week. And he, he's worried about the huge accumulation of debt that's going on around the world, and how a government's going to resolve that. I think that's a big issue for the kind of looking beyond the immediate short term. That's the biggest issue, I think, facing us all at the moment.
And that was the cliffhanger that you left the previous podcast on, which was that the amount of debt that has been accumulated by the major economies in the world, the amount of debt would shape and define markets. So did he have any theory as to how debt could be diminished? It's unlikely it'll be eradicated. So what does he think that governments can do?
Right. Well, actually, he did talk about that at some length, and he's developed a kind of framework for talking about all this. He basically says there are 5 options. I won't go through them all, but one of them is, austerity, basically, like we tried after the global financial crisis. In other words, really hack back on government spending. He doesn't think that's going to be very likely. It's not very popular ever with electorates. His key point is that it is in the hands of the politicians. They are kind of effectively taking over the determining what's going to happen next. It's no longer just the central banks. They are, in his view, fairly impotent now. They're just doing what they have to do. But we're seeing other ways that the governments can deal with it. There could be a default on debt, but that's pretty unthinkable. You wouldn't want the UK government to default on its debt. That would be a kind of disaster scenario. We could hope for very high growth. I mean, that's the other. The best way to get out of a debt problem is to have very high growth, but we know that's not possible. I mean, even if we saw what happened with the Truss government, that was not credible. They were promising, super high growth to get out of this straitjacket that we're all in because of the amount of public and private debt. So that's not really an option either, and productivity remains very low. So we can't really expect very high productivity to feed through into very high economic growth. So that's probably not going to happen. And that then leaves only 2 options, one of which is hyperinflation. In other words, you just let inflation rip, and that destroys the real value of the debt. And that's been tried in a number of places, but not recommended. Tends to be the kind of South American solution, if I can put it that way without offending our South American listeners. And the final way is financial repression, which is really what we've got at the moment, which is, in other words, keeping interest rates below the rate of inflation and gradually reducing the value of the debt over time. It's going to be a long haul, rather like happened after the Second World War, when we had a huge amount of debt after the war. And I think his view is that the most probable outcome is that's where we'll go, but that implies there's going to be interest rates are going to be suppressed. That will have other consequences. Inflation will remain probably above the 2% target, and so we'll just sort of grind through this period until something turns up, really. Not a particularly positive prospectus, I have to say.
Okay, you're sounding gloomy. Now, there's 3 reasons for that. You're either gloomy, you've either got a cold coming on, or 3, you've just got out of bed and you've got your sleepy voice on. But what should we do if markets are dull?
Before we finish that, I mean, I should say his view is that the answer to that is, equity markets are still the answer to that problem. They're the least worst option, if you like, but it's got to be the right kind of equities. I think that was his point. It's got to be the right kind of equities. That means it's got to be, quality companies, those who've got pricing power, those who've got good balance sheets, and so on. All those traditional things. He does think, though, that market indices or ETFs or index funds aren't going to do very well in this environment. But that if you have the right kind of equities, they're probably your least worst option over time. And he doesn't think, after the war, it was interesting. If you go back and look at that and what happened, equities and property, residential property, were the 2 best performing asset classes in that kind of period of financial repression. Another way of saying this is that it's really anything except bonds. That's really another way of saying it. If you after the war, people who bought bonds, government bonds, thinking they were safe and so on, they basically lost money in real terms over the next 30 years. It was an absolutely disastrous investment, and he thinks we're into that kind of environment again. Is he right? I mean, that's a good question. Is he right? I have a sneaking suspicion that he probably is right. Which is not necessarily gloomy. It's just, it says that there is a path through this. There's always a path through these kind of horrible economic outlooks. But this one is going to be, quite protracted, he thinks, just because politicians and indeed electorates aren't going to buy, as far as we can tell, the really radical solutions like we had in the 80s with Volcker and Reagan and Thatcher. I don't think people are ready for that yet. Anyway, let's put it that way. You need a real crisis before that's gonna happen. But the debt issue is there, it's coming. We can't get away from it.
Okay, so you're not being gloomy, you're being realistic. So aside from
That's what I was going to say. I'm not being grumpy or gloomy. I'm being, I hope, as positively optimistic as one can be in the circumstances.
The voice,
As an old guy who's been around for a long time, and tends, naturally to deplore the state of the world as it is today. But I think there are some real issues around this debt. I mean, the scale of it is just extraordinary. We've never seen anything like it before, just as we've never seen interest rates go as low as they have gone until we had the recent rate hikes. These are historically unprecedented circumstances.
So aside from taking that the experts' advice to allocate quality equities into your portfolio, what would you do, Jonathan, when markets are dull?
Right. Well, markets are dull. The best thing to do is probably, go away for a while and come back later. I mean, there's some great stories about, people in America who, had a portfolio of whatever it was. They may have inherited it, and they didn't know anything about it. They were, typically these were either kind of retired people or daughters of wealthy men, had this money, put it away, come back in 25 years and find that actually they'd done extraordinarily well just by virtue of doing nothing. So there is an argument for doing nothing. You have your basic asset allocation and you stick with it. And particularly this kind of climate, trying to get an edge in a period when there's so much uncertainty about which path we're going down, you're more likely to do damage than you are to do good. So I think the answer is definitely I don't know, read a few books, I don't know, study some history, do something less frenetic than watching the markets go up and down every day. That won't always be the case. There will be a signal soon that we need to maybe rack up our risk tolerance or cut it back again. But that would be my advice. So go away, man, go away. I still think that's a good piece of advice.
And in terms of me going away and doing something different, I think I would train to be a veterinary surgeon. I've spent a month's salary on my cat, who I'm looking at now. She's been proper poorly. And I was looking at Pets at Home share price, and it's doing pretty well. And I kind of understand now Pets at Home has got a veterinary section to it, but it's where you go to buy the food and the kibble, the treats, etc. And that share price is doing very well. And I was thinking, more or less, I am a shareholder after spending a fortune on her, but she's a lot better. Or I suppose we could just become tourists, and if we can afford the petrol or the diesel, even though that's unpopular, we can just go and, I don't know, go to National Trust properties, Jonathan.
Yes, that I've just done that. I just say on the pet thing, I mean, I totally agree. I think COVID had a significant impact on, people began to value their pets even more than before, and the numbers of pets are extraordinary. I think I didn't know until recently how many cats and dogs there were in this country, but it's a hell of a lot anyway. I mean, there's 10 million cats or something like that, I think, something like that. Anyway, and extraordinary. We went to a pet shop the other day, and extraordinary things you can buy in a pet shop. I mean, all these. I mean, I don't know what you've been doing, but I managed to bypass some of them. But bits of birds you can buy, sort of frozen, dry bits of bird that you wouldn't, apparently a treat, or sheep's bladders and things like that. I mean, well, quite extraordinary. Not to mention all the all the kit you can buy, the kind of clothes and other things, apparel you can buy for your animals. Quite extraordinary. Anyway, yes, so National Trust. I went to a very interesting one the other day. I went to a place called Chastleton, which is in Oxfordshire. No, is it in Oxfordshire? No, it's actually on the border of Warwickshire, Oxfordshire, and Gloucestershire, right in the corner of the border. And really interesting. I haven't been before. It's an old kind of stately house, I suppose you'd call it. A small one, a small stately house. The interest of it is the fact that it was built by someone in the early 17th century. By a guy who made some money. He was a lawyer, I think. And then, as the lady of the house, the last lady of the house before they sold it to the National Trust, said, that was as wealthy as that family ever became. That was from the guy who built it. He was quite wealthy. He'd made some money, built this, nice looking house. And then after that, it was a tale of gradual impoverishment over 300 or 400 years. They gradually got poorer and poorer. Poor people. They picked the wrong side in the Civil War. That was a bad start. which you didn't want to do that. So, and then they had one or two sons of the family who were as usual kind of indolent or extravagant, and they lost some money, and so gradually it went on and on until eventually it passed to a rather to a cousin, a rather eccentric cousin who was a don at Oxford University. And when they inherited it, they took one look at it. They thought, "Oh my God, what have we inherited here?" Everything was falling down. There were holes in the walls. But everything had been preserved. All the kind of the family heirlooms that they'd been able to keep, the pictures, the furniture, and so on, was all kind of rotting away. But it was all still there. And then that passed to the National Trust, and they couldn't afford to do anything to it. And so the National Trust took it on, and then they decided, rather interestingly, to just leave it as it was rather than to restore it. They said, why don't we leave it as a kind of monument to what happened to wealthy families who didn't have the wherewithal or the nous or the luck to preserve their wealth, which of course is what a lot of descendants of famous dukes and so on do today. They just didn't have that nous, and so it's there, and it's still very dusty, but it's fascinating. It really is fascinating. It's a kind of shows you a real life image of genteel decline. So something different anyway.
Yeah,
the cakes were good though. The cakes weren't 17th century. They were quite nice.
I think if I was to go, I'd have to take antihistamine tablets if it was very dusty. But that reminds me of the folly that is my castle, Lowther Castle, which doesn't have a roof, and that was tax evasion at its most base level. But
Where is that? Where is Lowther Castle?
I think that's the Lake District. Lowther
Right.
or Lowther. I say Lowther, which apparently is the wrong way to say it. Everyone else calls me Lowther, but it's Lowther. There you go. Gentility.
If you're going to have a building without a roof, the Lake District is probably not a good place to be, I would think, because it does have quite a lot of rain, doesn't it? I would have thought that would be your first requirement, really. That's where one of my family ancestors came from the Lake District as well. Did I tell you that before? No. They unfortunately he was a coin clipper and a sheep thief, among other, and a highwayman. So he was basically not a particularly virtuous gentleman, and I think he met his match with Judge Jeffreys, who I think he was hung.
Oh no,
but there you are.
That's a very sad end.
The family has been full of virtue ever since, of course, I hasten to add.
I was going to say, before you told me about the criminal element to your family, I was going to say we were probably related, but I think we'll.
Oh, certainly, I would think. Oh, certainly, yeah. We should do one of those programs, where you go back and they study your ancestors, and you're bound to find out you're related somehow.
No,
Probably, my ancestor might have been married to your ancestor. Who knows?
Oh, let's not go there. Be careful what you wish for. No, I wouldn't want to know. And with that, Jonathan, so we are approaching June very quickly. Do you anticipate that there will be vigorous action on the markets, equity markets, otherwise this coming month?
Well, the answer is I don't think there will be. But if we have a debt default in the US, of course, all the bets are off. The federal government's meant to be running out of money on June the 1st, according to Janet Yellen. So if that was to happen, then of course that would be quite a lively month. I think you see a lot of activity in the bond market. The bond market is worth watching though, because as you've seen, the yields have gone up again. Inflation figures from in the UK were very poor, the ones that came out yesterday, and they it may not be over yet. Inflation is still not under control, and I'm not confident it will be under control for a while yet. And that may mean that the bond market remains, yields continue to stay where they are. They certainly aren't coming down at the moment. So there could be some action in the bond market. Equity market, well, not so sure.
Many thanks, Jonathan. I look forward to catching you up in a month's time. Thank you very much. Take care.
Me too.